Hi, Peter Jones, Chartered Surveyor, author and property investor. In this, the last video of our series, we're thinking about property and tax. And I want to combine two statements which I often hear people say, but which I wonder whether they're actually compatible. The first is, my exit is death. Now this is something which I say from time to time, and the presumption behind that statement is that you're going to hold your properties forever, and that when you die, you'll still own those properties. You're not going to sell them before you die. It's just going to be an ongoing thing. And so then presumably your property business, which is probably going to be set up in a limited company unless things change at the next budget or a budget in the future, your limited company or the shares in the limited company are maybe going to go to your children or whoever you leave them to. So that's the one statement. And it sounds very worthy, doesn't it? Hold everything forever. They'll still be there when you die. Pass it all on. But the second thing which I hear a lot of people saying is they say, Peter, what I really want to do is I want to pay down all of my mortgages and so all of my properties are unencumbered, and then I want to leave them to my children. And I look at them and I say, have you actually thought about what you're going to be leaving your children if you were to do that? And they're going to look at me a bit blankly. Because the reality is, if you pay down all of your mortgages and leave all of your properties unencumbered to your children, who's going to be the main beneficiary of that? It's not going to be your children. It's probably going to be HMRC, because what will happen is inheritance tax will kick in, and depending upon whether you're married and doing this as a couple, depending upon how you've structured your entity, potentially your children, for example, could be paying on behalf, or whoever your solicitor may deal with this, it doesn't have to be your children, but whoever's dealing with your estate may end up paying out part of the value of the unencumbered properties at a tax rate of 40% as it currently stands under inheritance tax. And when I point that out, quite often you can see the sort of people's faces drop, because yeah, it's a bit disappointing. But there is going to be a tax consequence. So this is why I think the argument around should we pay off our mortgages or not pay off our mortgages is an interesting one. But I wanted to stick specifically to tax for the purposes of this video. So we need to make sure that we're going to structure things so that hopefully we're going to mitigate inheritance tax as well. Now, one of the benefits of constantly remortgaging your properties, when they go up in value, remortgage and then take that money out and spend it. Now that sounds completely reckless, doesn't it? Why would you do that? Well, you probably wouldn't do that until you've got to the stage where you have such a large portfolio that you don't need to buy any more properties. And then you can just live off the growth if you wish to. That's the point at which you could spend it on your toys. I'd suggest that before that stage it would be reckless and you don't want to do it. But for example, in 20 years' time, 30 years' time, when you've got 100 properties, you don't need any more. You've got all the passive income you could ever dream of. Every time they go up in value, you could take a little bit out. Now obviously the whole time you're going to be building your debt liability against the assets. Is that a good thing or a bad thing? It all depends. What I'm thinking is that if you keep taking the money out and building the debt against the assets, then when it comes to inheritance tax, you're only going to be paying inheritance tax on the difference between the loan and the value of the property. So you're reducing your inheritance tax bill. You're also managing to get money out of your business, which presumably at some stage you want to do anyway. But you need to think about what it is you're trying to achieve. Even if you structure everything through a limited company, if you pay down the mortgages in your limited company, the upshot of that is the value of the shares of the company are going to increase. So even having it within the shell of the company doesn't mitigate inheritance tax per se, from a very basic level anyway. You need to talk to your accountant and your solicitor how to structure things. But at a very basic level, as you pay down the mortgages within your limited company, you're just increasing the value of the shares. So if you're going to pass the shares on death, then again you've created an inheritance tax liability. So maybe the answer is that when you set up your limited company, if you really want to pass things over to your children when you go, maybe you bring your children in as shareholders at the very beginning. Now that sounds all well and good, but as I've said all the way through this series of videos, there's upsides and downsides. One of the things which is happening now is a lot of people are going into limited companies because of Section 24. Lenders are beginning to become much more open to lending to limited companies. But one of the questions which they may ask is who's the shareholders within the company, and can we have a look at their financial credibility? So if you're bringing your children in as shareholders, for example, that may affect the lendability of your company. I don't know, talk to your mortgage broker. If the bank understands what you're trying to do, they might be cool with it, but it's going to vary from bank to bank and criteria to criteria. So all of these things have things to think about. There is no answer. I wish I could stand here and say, this is exactly how you need to do it. It's very easy, just do this, this and this and everything will be fine. But unfortunately in tax and property, it doesn't work like that. But I hope I've given you plenty of things to think about, and so you can perhaps go and have a chat with your accountant and bring all these issues up with them. Until next time, here's to successful property investing.